Profit is undeniably important for any business. It's the fuel that keeps the engine running, the scoreboard that tells us if we are winning, in a way. So, when we think about financial objectives for a company, maximize profit seems like a pretty obvious and straightforward goal. However, if we dig a little deeper, we find that maximizing profit on its own is actually not a very well-defined, or even a very helpful financial objective in the real world. Think about it like this. Imagine you're trying to maximize your speed while driving a car. You could simply floor the gas pedal all the time. Would that be a good objective? Probably not. You might get there faster in the short term, but you would likely run into some serious problems. You might crash, you might get speeding tickets, you might wear out your car much faster, and ultimately, you might not even reach your destination safely or at all. Simply focusing on maximizing speed without considering safety, fuel efficiency, or the lifespan of your car is a very narrow and ultimately flawed objective. Similarly, maximizing profit is too narrow and lacks crucial context when it comes to business. The biggest problem is the question, maximize profit over what period of time? Are we talking about maximizing profit this quarter, this year, or over the long term, say, the next 10 years, or even longer? These are very different things, and focusing solely on maximizing short-term profit can actually damage long-term profitability and the overall health of the company. For example, a company might try to maximize short-term profit by drastically cutting costs. They might reduce spending on research and development, which are investments in future innovation and growth. They might cut back on employee training, which could lead to lower quality products or services and decrease customer satisfaction over time. Or they might use cheaper, lower quality materials in their products to reduce manufacturing costs and boost immediate profit figures. These actions might look great on the income statement in the short run, showing increased profits, but they are likely to weaken the company's competitive position, damage its brand reputation, and ultimately reduce its long-term profitability and sustainability. Another crucial element missing from the simple objective of maximizing profit is risk. Think about investing. You could potentially maximize your return by putting all your money into a very risky investment, like a highly volatile stock. It might pay off big and you might see a huge profit in a short period. But there's also a significant chance you could lose a large portion, or even all, of your investment. Simply aiming to maximize profit without considering the associated risk is incredibly reckless. A sound financial objective needs to take risk into account. A sustainable and responsible approach is to aim for a good return for a given level of risk, or to minimize risk for a given level of expected return. Furthermore, maximizing profit often ignores other important stakeholders in a business besides just the shareholders. Companies have employees, customers, suppliers, and operate within communities. Focusing solely on maximizing profit for shareholders might lead to decisions that are detrimental to these other groups. For instance, a company might maximize profit by exploiting its employees, neglecting customer service, or polluting the environment. While this might boost profits in the short term, it can lead to employee dissatisfaction, customer churn, damage to the company's image, and potential legal and regulatory issues down the line. A more comprehensive and sustainable objective would consider the interests of all stakeholders, not just shareholders. Instead of maximizing profit, a better defined and more useful financial objective is often described as maximizing shareholder wealth or increasing firm value. These objectives are broader and more long-term oriented. They consider not just profit in a single period, but the present value of all future cash flows that the company is expected to generate. This inherently takes into account long-term sustainability, risk, and the overall health and strength of the business. It's about building a valuable and enduring enterprise, not just squeezing out the highest possible profit in the next quarter, regardless of the consequences. So, while profit is certainly vital, it's not the ultimate goal. Building long-term value while considering risk and stakeholders is a much more robust and responsible financial objective for any company.